You know, if you've ever picked up a trading book, you've heard the advice, when a stock blasts through to a new high, that's your green light to buy. It's the classic breakout. But what if that conventional wisdom isn't just a little off? What if it's actually a trap? Today, we're digging into a fascinating analysis that flips that exact idea on its head. So let's just ask the question right out of the gate. That moment of pure excitement, right? When a stock's price closes above yesterday's high, is that really the best time to jump on board? Or can it maybe, just maybe, be one of the absolute worst? This is the core puzzle we're going to try and solve. Okay, so here are the two battling ideas. On one hand, you've got the textbook rule, the one you see everywhere. Buy when the price closes above the previous high, it signals strength, it signals momentum. Simple. But then you got the complete opposite, the contrarian rule. It says to buy when the price closes below the previous day's low. It feels kind of wrong, right? A little uncomfortable. But that's exactly what we're here to look into. And that brings us to the whole idea here. We're flipping the trading script completely. What actually happens when we decide to do the exact opposite of what every book seems to tell us? Let's find out. Well, the theory goes like this. Buying a stock when it's going down, buying a dip, is psychologically really tough to do. And because so few people are actually willing to step in and take that risk, the market might just offer a hidden reward for it. They call it a risk premium. You're basically getting paid to do the uncomfortable thing that most other traders are running away from. So, what did all that data reveal? And the results are, well, they're pretty shocking. The data clearly shows that the contrarian approach, buying on weakness, had almost double the performance edge compared to the classic textbook strategy. Now we have to figure out why. So what about that conventional buy the breakout rule? Well, according to the sources backtests on the S&P 500 ETF SPY, the strategy didn't just fall short, they often failed completely. In several tests, it started losing money almost immediately, and their words, not mine, the account got blown up pretty fast. It consistently ended up deep in the red. But now, let's look at the flip side. When that contrarian strategy was applied to SPY over the last decade, the results were pretty compelling. Not only did it outperform just buying and holding SPY, but it delivered a solid 15% rate of return. It also had a really respectable Sharpe ratio of 0.94, which is just a fancy way of measuring how much return you're getting for the risk you're taking. And we see the max drawdown was 22%, which is the biggest that the strategy took from its peak. Okay, so the data shows us what happened. But honestly, the really fascinating question is why? Why on earth does the uncomfortable, counterintuitive trade seem to perform so much better? And the answer, it turns out, is all about human psychology. One of the key ideas here is something called retail herding. You've probably seen this in action. It's that natural, predictable tendency for individual investors, or what we call retail traders, to just follow the crowd. When they see a stock taking off, they pile in, chasing the momentum that's already well underway. This really paints a picture of the market as a game between two very different kinds of players. On one side, you have the crowd, right? They're driven by emotions, that fear of missing out or FOMO, and of course, panic selling. And on the other side, you have the pros, the big institutions, and they play a totally different game. They're often selling into that strength and buying or accumulating on the dips. So let's just break down those drivers. You've got FOMO, which creates those super crowded breakout trades where everyone jumps in at once. Then you have risk aversion, which causes people to freak out and sell at the first sign of a dip. The professional institutions, they understand these very predictable human behaviors, and they can often position themselves to take advantage of them. And a quote from this source material just absolutely nails this dynamic. Pro traders sell into strength while buying during dips to accumulate positions. That one sentence really captures the entire game we're talking about here. So all of this is leading us to a really powerful conclusion. It's about questioning the rules revolving taught and really trying to understand the deeper psychology that's moving the market. So here's the absolute crucial point. That super exciting, obvious buy signal that gets the masses piling into a stock, that could be the exact moment that the big professional players are quietly selling their shares and taking profits. The retail crowd is basically providing them the exit door. And this is really the ultimate lesson from this whole analysis. Don't be afraid to question that conventional wisdom. Remember that the big players have a funny way of turning what looks like an obvious signal into something that's just overhyped. And that really leaves us with a final thought to chew on. If this one huge, widely accepted rule about buying breakouts might actually be a trap, It really makes you wonder, doesn't it? What other market rules are out there just waiting to be broken?